What's up, guys? It's Pac. Welcome to video 1, market structure and why you should annotate your charts. So throughout this video, we're going to be discussing a few things, discussing the difference between the high time frame and the low time frame and what I use as my high time frame and low time frame. We're going to be discussing how to identify a valid high, how to identify a valid low based on the logic that I use. We're also going to be establishing and discussing how is a protected high and a protected low come into existence in the market, because a valid high is not always a protected high and a valid low is not always a protected low, and the difference between the two. And then we're just going to talk about the importance of continuously annotating and tracking your structure on your screen so that you're not on the wrong side of the market. Okay, so without further ado, we're just going to hop right into this. All right, so as we know, price moves in 3 different conditions, right? It's going to be in an uptrend, which in an uptrend, all we're doing is establishing a series of lower lows and higher highs, as you can see here. And in a downtrend, the second option is all we're doing is establishing lower lows and lower highs, right? That's how you identify a trend, which is super important, which I think most people are going to be able to do just by eyeballing at a chart. And then the third condition is a range, which we'll talk about later on in a future video. But today I want to really focus in on those trending environments and how to track the structure within those trending environments. Because a lot of people will make this mistake and they'll end up on the wrong side of the market, which if you're on the wrong side of the market and you think that the price is moving in an uptrend on whatever time frame you're looking at, but it's really had just transitioned to a downtrend. Well, now that all these longs that you're looking for, not saying you can't make money on them, but what will end up happening is you'll be expecting it to go take a higher point because you're expecting a new high to be put in. And what happens is it fails, you get smoked, stop loss gets hit, you go cry, and you end up living in the basement, right? Something we never, all of us don't want to do. So what we need to do is we need to be able to establish valid highs and valid lows. So how do we do that, right? So for a valid low to be established, it's very, very simple. We just need to close above the bearish candle that put in our low. So if we're looking right here at this valid low structure that I put in, the candle that put in the low is this candle right here. So for a valid low to occur, what has to happen? We need to close above the bearish candle that put in the low. We need to close above the bearish candle that established the low. Okay? That's how a valid low is established. Very, very simple, but a lot of people will miss that. And we're going to go over through some examples later on in this video of everything all at one time. How is a valid high established? Well, it's just the opposite of a valid low. So a valid high is established when we close below the bullish candle that puts in the high. So again, how is it established? We close below the bullish candle that established the high. And that is how a valid high and valid low occurs. Very, very simple. Okay, so we're going to hop over to the charts just so that we can start identifying some valid highs and valid lows. All right, so let's just look at valid highs for a second. Let's see if valid highs and where they occur. Again, these aren't protected highs. These are just a valid high. This just means that high has been put into the market, okay? So, again, what do we have to see? We have to see a candle close below the bullish candle that put in a high. So very clearly you can see that here we're in an uptrend, right? And you can see a series of bullish candles, but we don't close, very clearly you can see that in this run up right here, going up, you can see that we did not close below any bullish candle that's trying to establish a high. we trade down, and then we trade back up. And you can see we still have not closed below a bullish candle that's established the high until when? Until this point right there. You see we have finally closed below the bullish candle that put in the high, the highest point, because we closed above here. So that's a valid high. That right there would be considered a valid high. Here. So we'll just mark that. We'll just put a little green box around it here. That's your valid high right there. Okay, and as price starts trading up again, we have a bullish candle that established a high, and we failed to close below it. So this is not a valid high. This is not valid high, not valid structure. We're still trading up. You can see this put in a new high. We have not closed below. Continue trading up. So when do we get a valid high? When this candle, because it's bullish, not the bearish one, but when the bullish one got closed below from this candle. So now here we have another valid high put in. Here. These are our valid highs. And as we continue with structure, you can see finally we put in another, we trade up. We'll have another valid high here because we finally closed below the candle that established a high over this point, because this was our last valid high. As you can see, we have a closure, so there's another valid high. Okay? Again, once we trade above that, we need a closure now below this candle here, because this is what put in the high over this, because this one didn't close below, and then we put in a new one. So again, we have another valid high. Very simple, right? All we have to do again is close below the bullish candle that put in the high. Okay? And a high is with body closures. So a little thing you can see is, hey, why is this not considered the high? Let's delete all this so that we can see. Why is this wick not considered the high? Well, because this is a bearish candle. So we're only looking at bullish candles. Only looking at bullish candles and when they get closed below. Bullish candles. Bullish candles. So there's a valid high there that I missed as well. Bullish candles. The bullish candles establish highs, not bearish candles. Okay, so let's look at valid lows. Valid lows. Valid lows are going to occur when a bearish candle that puts in a low gets closed above. So here, right, because this is the bearish candle, we'll turn this red so it's easier to see. Red. We have a bearish candle that got closed above. So this is going to be a valid low. We have a bearish candle that got closed above. Again, valid low. We have finally have the bearish candle that establishes the low here. Get closed above. So that's a low, a low, a low, a low. This isn't a valid low in our market. Why? Because we didn't close above the bearish candle that established the low. Let's see. We have a low here. Why? Because we closed above the bearish candle that established the low. That is quite simply how you establish valid lows and highs. Again, when it comes to valid lows, we need to close above the bearish candle that put in the low. And when it comes to valid highs, we need to close below the bullish candle that put in the high. Okay, so remember that. Go back, test that. So moving on to protected highs and lows. What is the importance of protected highs and lows? Protected highs and lows are going to A, establish a trend, but B, once they get violated, this is going to be when our structure actually shifts, is when a protected high or low is violated. That's when structure actually shifts. not when a valid high or low gets violated, when a protected high or low gets violated. Okay? So how do we establish a protected high? Well, a protected high first, it has to establish we have to have a valid low, and it has, let me backtrack. A protected high is only established in a downtrend. You can only have protected highs in a downtrend. So for this to be established, first we have to put in a valid low here. We have to trade away from that. And then for this protected high to be established, we have to close below the valid low that brought the high. Okay, this high would now become protected. So once that market structure shifts and continues, that is when your protected high is established. Okay, so you have to have a valid low, you have to have price trade away from it, create a valid high, and then it becomes protected once it closes below the valid low that brought that high. And we'll show examples. Same thing with protected lows. Protected lows only occur in uptrends. You can only have protected lows in uptrends. Again, very simply, you have to establish a valid high that price trades away from, establishes a valid low, and then closes above the high that brought that low. This low again is not protected until when the close above the previous valid high has occurred. Okay? And so then, when does market structure shift? Market structure shifts very simply when we have a series of protected lows and we have a closure below. So you had these series of protected lows, and we'll move this back to red, or we can do green. We have these series of protected lows, and then very simply, once this got closed below, because we were in an uptrend, very simply, this would now be this would now have shifted from bullish structure to bearish structure because of this shift right here below a protected low. Okay, so let's go look at some examples. Okay, for example's sake, let's say that this was our protected low, okay, because price closed above the valid high that was established here. So we'll put a green dotted line so that we know it closed above to be able to validate this as a protected low. Okay? So when is a valid high, when does a valid high occur? Back to previously in the video. Go rewatch it if you don't remember. It's when we close below the bullish candle that established the high. So where's the bullish candle in here that establishes the high? It's right there. And we clearly close below it right there. Okay, so we have a high occur, and we trade away, and then we close above. Once we close above the high of that candle, right there where that dotted line is. I know it may be hard to see. Let me delete these drawings. I draw a lot. Once we close above, this low now becomes our protected low. Okay? As price keeps moving up, you'll see we establish a high here because we closed below. So now we have a protected low here. And again, we trade up. We establish a high because we closed below. We trade down, and then we finally close, so we have a protected low. Now, you're going to ask me right here on this price action in particular, well, did we not close below a protected low, meaning that we should short to bearish structure? We did, but this also comes with price expectations, which we'll be going over on a later video. Right now, I just want you to be able to identify valid highs and lows and protected highs and lows. So we'll just continue. Again, we don't have a valid high here until when? This point here, because we closed below, making what? This our new protected, or a valid high. This becomes our new protected low when we close above here. And we'll do one more just for example's sake. We have a closure below the bullish candle, making this a valid high. Once we close above this, this is now going to be we're going to be continuing structure, which means the low that brought this, if I can get this right, making this right here our protected low. Okay, and as we can see, we're clearly in an uptrend. Don't worry about this right now. We're going to go over that in a future video. So let's go look at when our price shifted. Okay, when did our price shift? We have a protected low there. We have a protected low here. And that is our last protected low, because you can see when we trade down, we failed to trade back up and trade down. Okay, so when does our price shift in structure? Our price shifts once we close below a protected low. That's when it'll shift from bullish to bearish. If it closes above a protected high, it'll shift from bearish to bullish. So where is our protected highs going to occur? Well, our first protected high is going to occur from the high that brought the break of structure. So this up here would be now our protected high. It turned from a valid high to a protected high. Why? Because we broke structure. So this is our protected high in the red circle. And as we trade down, we trade up, we establish a valid low, we trade up, and then once we close below this, we now have established a protected high here. And the same thing keeps going down. Once we close below this one, we now have a protected high here. Same thing here, because we established a low because we closed above, we end up with a protected high here. Once we close, remember, all these need to close below those last lows, because these are just valid lows, not protected anymore. Boom. Same thing occurs here. Same thing occurs here. So here in the structure, we can clearly see and identify, hey, we have a series of protected lows. Protected lows mean we're in an uptrend. A series of protected highs mean we're in a downtrend. It is literally quite that simple. Again, talking about the importance of tracking. This is the last point we're going to make in this video, and then we'll move on to the next one. The reason you want to annotate your charts, the reason you'll see a lot of my charts, for example, I use a lot of drawings, like these purple tools. This was price action from Friday, March 25th. If I'm circling my highs and lows, right? If I'm tracking, then I know if price has shifted on this time frame. Okay? And then I know when we shift back down, because I'm keeping the charts marked up the whole time. And so you'll see my charts look like something like this. Now, the key is that we need to track on both time frames. Okay? That is why we're here. We need to track on both time frames. It's not enough to track on one time frame. Just your 1 minute or your 12 minute, or your 1 hour and your 5 minute, whatever structure you decide to use. You have to keep on both. So I'd highly recommend keeping two charts open. I trade like this. I'll have my 1 minute chart on my left side a little bit bigger, like this. And I'll have my 12-minute chart very small on that side. So I can track both structure, because if we know where price is going, then we know how to get involved. I'll see you in video 2.